US stocks rise and Treasury yields fall as weaker US manufacturing activity adds to signs the Fed can cut in September. The Aussie dollar continues its fall, but CPI data tomorrow could provide support. And Vietnam's exports surge off the back of China's supply chain diversification. That's coming up in our 5 Things in 5 Minutes. And then, in our bonus deep dive interview, ANZ Group Chief Economist Richard Yetsenga examines what President Donald Trump version 2.0 might mean for global inflation, interest rates and trade.
We still expect the direction of interest rates in the US to be down, but maybe the market will have to trim a little out of its current expectation if Trump wins in November.
But first, in 5 and 5 with ANZ, US stocks rose overnight and the yields on US Treasuries fell slightly as markets bedded in expectations the FOMC will start cutting rates in the US from September. Overnight, the Dallas Federal Reserve's Manufacturing Activity Index declined more than expected in July, another piece in an economic puzzle which saw the Fed's preferred PCE core inflation measure fall to 2.6% on Friday, closing in on its 2% target. The S&P 500 was up 0.3% and the Nasdaq up 0.4% at 4 a.m. Sydney, Melbourne time, ahead of a couple of big tech results. But the big event this week is the FOMC meeting on Thursday morning Australia-New Zealand time. Here's ANZ economist Bansi Madhavani.
There is now a market-wide consensus that economic backdrop is coming together for the Fed to be able to cut rates soon as September. Our expectation is at their meeting this week, the Fed will acknowledge the progress made so far and indicate that rate cuts are now in the horizon.
Number 2. With the FOMC expected to hold rates this week, the question becomes what is needed to lock in a September move. Bansi says the FOMC will be looking to balance its twin objectives of price stability and maximum employment.
Firstly, the Fed would not want to see any inflation shocks, which means that the current disinflation journey needs to broadly continue. Secondly, the Fed would not like to see the labour market unduly weaken from here on. The labour market has broadly rebalanced and we've seen that in terms of softening payroll growth, slowdown in hiring and gradual rise in unemployment. The Fed would not want to see any signs of sudden weakness in the labour market.
Number 3. One of the biggest currency movers over the last 2 weeks has been the Australian dollar, which has fallen from nearly 68 US cents to below 66 US cents. Here's ANZ Head of FX Research Marja bin Zaman on what's driven that fall and what might happen next.
Thanks to global equity markets in sell-off mode given a mixed earnings season, we've seen the unwind of carry trades with flows into haven currencies such as the yen and Swiss franc. Furthermore, we've also seen the decline in commodity prices on the back of slowing economic momentum in China, and all of these have been contributing factors to the Aussie decline. This week, we expect the Aussie dollar to be driven both by market beta factors and interest rate dynamics, given the domestic data releases that we're expecting to see.
The Aussie dollar was at 65.44 US cents at 4 a.m. Sydney, Melbourne time. And tomorrow's Australian CPI inflation figures for the June quarter is the big one for the markets to watch. The Kiwi dollar down 0.3% at 58.77 US cents. Number 4. Marjabin says the Aussie dollar could benefit if the inflation number is stronger than expected, which would increase the chances of the RBA hiking in August. And that's at a time when most other central banks are cutting.
A stronger than expected Australian CPI print combined with stronger activity data such as retail sales will likely lead to an increase in market expectations for an RBA rate hike in August, or it might push rate cuts further out in 2025. Given that a higher RBA rate or a higher for longer RBA coming at a time when other central banks are cutting rates may present a scenario that is likely positive for the Aussie dollar.
Number 5. In Vietnam, inflation rose a touch to 4.4% in July from a year ago, thanks to higher pork prices caused by a swine flu outbreak. But it was the trade data for July that really stood out. Vietnam's exports rose 19.1% in July from a year ago. That was the fastest growth rate since January and lifted Vietnam's trade surplus to $2.1 billion US. That's above ANZ's forecast for $2 billion. ANZ FX analyst Kosani Basak says strong exports of electrical goods and electronics were the main driver. China's move to diversify its export supply chains to include the likes of Malaysia, Thailand, Vietnam and Mexico is having a real impact. It's called China Plus One.
Vietnam has been benefiting from the China Plus One policy because many of the FDI inflows has been redirected from China to Vietnam, which directly contribute to higher exports. And in rest of the year, we think that FDI flows will be solid, which will continue to drive exports.
Kosani Basak there, speaking from Bengaluru. Now, in our bonus deep dive interview, ANZ Group Chief Economist Richard Yetsenga looks at what a President Donald Trump version 2.0 might mean for global inflation, interest rates and trade.
I think the first thing for me, Trump 2.0, is if you needed validating, it does validate the idea we're in a different political environment globally. Certainly this year we've had enough political developments, a minority government in India, France needs to cobble together a coalition to govern. We've had enough of surprising results to validate that view. But remember, Trump 1.0 in 2016 was really greeted with a lot of surprise, in some ways denial. Maybe we're in the fifth stage of grief, now it's acceptance. But with acceptance, I think, comes a recognition that we survived Trump 1.0. It might have been disruptive and felt a little bit strange, but we should view this as a period of geopolitical flux. And in flux, there's opportunity as well as cost. There's no doubt some sectors will find a Trump presidency difficult, but others, perhaps domestically focused sectors in the US, perhaps the energy sector, perhaps even economies like Asia, whose relationship with the US is much more in Australia, much more investment than trade, will actually find some benefit out of this. And let's not forget, Trump, as with all US presidents, wants the economy to be strong, wants the stock market to be strong. So his rhetoric is likely to continue to grate in some ways, but what will matter actually is the outcomes.
What about on the inflation and interest rates side?
The sense we have of Trump's approach to fiscal policy is it will be more stimulatory. The makeup of Congress here is pretty critical. If the Democrats can retain a balance of power, then the stimulation will be marginal, but it will be additional. So even in a kind of the modest scenario, our expectation is that Federal Reserve rate cuts, the chance for those is probably a bit less under a Trump presidency. We still expect the direction of interest rates in the US to be down, but maybe the market will have to trim a little out of its current expectation if Trump wins in November.
And is there a chance that his trade policies could actually increase inflation in the United States and add another impulse to global inflation?
The average US tariff at the moment is 3%, so not far off zero. Trump is proposing an average tariff of 10% or an across-the-board tariff of 10%. And he has floated a 60% tariff on China. The 10% we should probably presume, the 60% seems less likely, but certainly broad-based tariffs should be inflationary for the US. Part of the reason the Fed may have the ability to ease a little bit less. But also the US economy is 25% of world GDP. So if the US, even if it's inflicted from policy, has a bit of an upside inflation surprise, I would expect that to affect the global inflation dynamic as well.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, July the 30th. Look out tomorrow for a preview of those Australian key inflation figures for June. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.